Good morning and welcome to today's webcast, ASC 606 Revenue Recognition and Professional Service Firms. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Hello everyone, welcome. My name is Swartos. I'm in the Seattle office. I've been with Moss Adams for about 13 years. I work on a variety of clients in the professional service industry, including architects, actuaries, and record keepers.
Hi everyone, my name is Kellie McKenna. I'm a manager in our Seattle office. I've been at Moss Adams for 6 years, and through that time I've been serving a variety of clients in the professional and financial service groups. So on our agenda for today, we are going to go through a quick refresher on the 5-step process as outlined in topic 606. Then what we've done is break out the implementation process into 4 key stages, which we'll go through. After that, we'll start to dive into major contract types and identify some important aspects you should keep in mind when applying 606 to these contracts. We will then go through some other considerations to keep in mind, including changes to capitalization of costs associated with obtaining a contract, as well as some general implementation. We've also put together a recommended timeline for implementation that lines up with the 4 phases we've identified. Lastly, we will have time for questions from the audience.
All right, so our objectives today are going to be a high-level overview of the 5-step process, and we're also going to dive into various contract types, things that you should consider when you're under the. Hopefully, you're going to come away with a better understanding of the new standard and how it may impact, as well as some ideas. That process goes smoothly.
Briefly, before we jump into the 5-step refresher, I just wanted to iterate why the standard was issued. What Topic 606 is trying to accomplish is really establishing comparability within financial reporting across various industries by creating this uniform framework. Right now, GAAP contains over 150 specific revenue recognition standards, and so frequently economically similar transactions resulted in different accounting and were not comparable. 606 also aligns GAAP with international accounting.
So we're at our first polling question.
All right. Our first question is, how prepared is your company for the upcoming changes surrounding revenue recognition? And your options are not at all, starting to think about it, we have a plan in place, just haven't started yet, or a transition plan is in process, we have a solid implementation team, and we're feeling good. I'll give everyone a few moments to respond. To participate, please click the button next to the answer you choose and hit Submit. And I'll give everyone a few more seconds here. And let's take a look at the results. Back to you guys.
All right, well, I am glad to hear that a lot of you are starting to think about it. Now is the time to think about it, as it is coming up very quickly. The end of 2018, here before we know it. So we are glad you're with us today to learn more about it and more prepared at the end of the call. So we're going to go through a refresher on the 5-step process. If you can believe it, the standard has been out since 2014. So it's been a long time coming, and I'm sure you have attended some training along the way where you've learned about the 5-step process. But as a basis for our conversation today, we're going to walk through each step briefly, remind you of what each step means, and then we'll dive into things that are more specific to the professional service. So as a refresher, the first step, the easiest step, identify if you have a contract with a customer. So contract's defined as an agreement that creates enforceable rights and obligations. There are several requirements for a contract to be considered a contract. There has to be approval and commitment of the parties. That can be in writing or oral. There has to be identification of rights and payment terms. There has to be commercial substance to the transaction, so your future cash flows are going to be impacted as a result. And collectibility must be probable at inception. You need to consider if the customer has both the ability and the intent to pay when you're considering if collectibility is going to. So then the next step, once you've identified that you have a contract, is to identify performance obligations within the contract. So that's just defined as a promise in a contract to transfer a good or service. It must be a distinct good or service or a series of substantially similar distinct goods or services that have the same pattern of transfer. So some questions to ask yourself when identifying performance obligation is, does the promise in the contract benefit the customer on its own? Is it used as an input to produce a combined output? Does the promise significantly modify or customize another good or service in the contract? And is it highly dependent or interrelated with other goods or services in the contract? Each arrangement is going to require management judgment. Management judgment is something that we're going to be bringing up a lot because throughout the standard there's a lot of areas where management is going to be required. And the promise in the contract has to be capable of being distinct. However, if the goods and services aren't distinct within the context of the entire contract, so they aren't separately identifiable from other promises in the contract, then there would only be one performance obligation. We're going to go through that and how that impacts performance further in a little bit. So the next step is going to be determine the transaction price. This is going to be defined as the amount of consideration a company expects to be entitled to in exchange for transferring goods. It sounds pretty simple on the surface, but there are complexities surrounding variable consideration, which we're going to cover later in the presentation. So now you've gotten through the first 3 steps, and so you're at step 4, which is allocating the transaction price to the performance obligation. This step is going to be very straightforward if there's only one performance obligation. There's multiple performance obligations. It'll get a little trickier, and you're going to allocate the price to each performance obligation based on relative standalone selling price. We're going to cover this a little bit later as well. So finally, you've made it through all 4 steps, and you are ready to move on to step 5, recognizing the revenue, which you're going to recognize that over time or at a point in time based on when the performance obligations are applied. There's several ways to measure the progress over time, which we will get into a little bit later in the presentation.
So now we're going to get into the 4 phases of implementation. We went through and identified the key stages for implementing Topic 606. So phase 1 is perform discovery and scoping. Phase 2, assess the impact. Phase 3, quantify and document. And then phase 4, financial statement disclosures. During this webinar, we are primarily going to focus on phase 1 and 2, which we will expand on in just a minute.
So the first phase, perform discovery and scoping. This is going to involve taking an inventory of all of your various contract types and determining which revenue streams you're going to perform a technical. So we've identified for the purpose of the presentation some major contract types that will impact professional services. Fee for service, based on actual time incurred or a fixed fee arrangement, principal versus agent arrangements, and contracts with variable consideration.
Now we'll take a look at phase 2, assessing impact. So during phase 2, you'll want to start to walk through the revenue process with management and other key members of the organization, and really identifying who will be involved in this implementation process. You also need to identify significant contracts and determine which contracts will need to be individually evaluated and which contracts can be assessed using the portfolio approach. Also a very good time when you should review your current accounting policies compared to Topic 606, identifying where you think significant changes. And with this, consider how your revenue streams should be accounted for under the new accounting standard. You'll also want to start to evaluate if the full or modified transition method is most appropriate for your company.
So we've got our second polling question.
All right. What are you most concerned about in regards to the new standard? Impact to accounting procedures surrounding revenue recognition, system changes required to meet reporting requirements, resource constraints for implementation process, or additional financial reporting and disclosure requirements. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. I'll give everyone a few more moments to make a selection. And let's take a look at the results. Back to you guys.
All right, so it looks like we've got a mixed response. So there are a lot of concerns out there. We are glad you're with us so that we can try to address some of those. So next we're going to go through evaluating major contract types. We're going to dive right into fee-for-service type contracts. The first being contracts based on actual time incurred. So this is exactly what it is. It's a contract based on the actual cost of time incurred on a project. And this would be any type of contract that's based on actual hours worked. These types of contracts could be less than a year or more than a year, and that will impact your revenue recognition. These types of contracts are going to impact many types of companies, including law firms, accounting firms, architects, engineers, actuaries, and consulting firms, just to name a few. Some key considerations for these types of contracts. The first would be determining the number of performance obligations. When you're going through this, you want to consider the finished product or deliverable considered a single performance obligation due to highly interrelated inputs to obtain one distinct output. I think this is best illustrated with an example. So assume that there's an architect that has a contract to provide design services for a new office building. The architect is likely going to conclude there's one performance obligation, which is the design of the space. Although there are many activities involved in the design of the building that are capable of being distinct, there are many inputs that are highly interrelated and result in one distinct output. If there's more than one performance obligation identified in the contract, then the transaction price would need to be allocated to each separate performance obligation. Using the same example as before, assume that the architect has a contract to design 2 separate distinct structures under the same contract. Those structures aren't integrated or connected, and theoretically the customer could benefit from each structure individually. And they could also hypothetically select a different architect to build either structure without significantly impacting the other structure. In this case, you would likely conclude there's 2 performance obligations And then you would need to allocate that transaction cost to the performance obligations based on relative standalone selling price at contract in. So the chart on the next slide is something that will help you walk through this process of determining standalone selling price. So the best evidence for standalone selling price is going to be if the item is already sold by the company on a standalone basis. And then that would set your standalone selling price and would be pretty straightforward. If the good or service is not sold separately, then there's several options to estimate the standalone selling price, which is depicted on the chart on this slide. And another thing to note is that you allocate the cost at inception of the contract. The allocation doesn't change based on subsequent changes to the standalone selling. So if pricing for the performance obligation is not highly variable or uncertain, there's two approaches that you can take. The top-down approach is the first, which is also known as an adjusted market assessment. In this approach, you should consider competitors' pricing for similar goods or services, adjusted for any factors specific to your company, such as your position in the marketplace, expected profit margin, customer base, geographic base, etc. You also want to consider, is there a history of providing price concessions? And if so, you should factor that into your standalone selling price assessment. The next approach for pricing that is not highly variable would be the bottom-up approach, which is also known as the cost plus a margin approach. In this step, what you would do is estimate the costs the company would typically consider when setting standalone selling prices and set a reasonable margin based on the following factors: looking at margins for similar products, market data on historical margins for the industry sales price averages, market conditions, profit objectives, etc. You basically would back into the standalone selling price based on a reasonable margin that you're trying to achieve on the. And when you do this, you will look at both internal and external factors. There's also a third approach that is to be used if pricing of the performance obligation is highly variable, and that would be the residual approach. So this is going to involve deducting the sum of the estimated standalone selling prices for all the other goods and services in the contract from the total transaction price to back into an estimated standalone selling price for the remaining good or service. And so this approach can only be used if pricing is highly variable. So if you sell the good or service to another customer for a broad range of prices, or if a price has not been established because you've never sold that product or service before. This is kind of the last result. You want to consider the other two methods before you consider this approach, as it's used in very limited circumstances. So some key takeaways for fee-for-service type contracts. Typically, time and material or fee-for-service type contracts will follow a similar pattern of recognition as legacy GAAP, which means you'll just recognize the revenue over time as the performance obligations are satisfied. This is going to require management's judgment, and you should document your considerations and your conclusions as you go through the process, and also consult with your auditors and any third-party users of the statements. So the next type of fee-for-service type contract we're going to talk about is a fixed fee contract. So any type of contract that's based on a set dollar amount. The customer pays one fee, but there may be separate performance. And revenue may be recognized over time or at a point in time. And this is a type of contract that we see with a lot of different professional service type companies. So the key consideration for fixed fee would be, when do you recognize the revenue? Is it recognized over time or at a point in time? Criteria for the revenue to be recognized over time. There's several different factors listed in the guidance where you would recognize revenue over time. So the first would be, does the customer simultaneously receive and consume the benefit provided by the company's performance as the company? This criteria really does impact the professional service industry, as it applies primarily to contracts for service. The benefit of the service is transferred to the customer as the company performs over time. Therefore, you would recognize your revenue as that performance is completed over time. The next consideration would be, does the company's performance create or enhance an asset that the customer controls as the asset is created or enhanced? Examples of this would be construction or manufacturing contracts where the customer controls the work in process, or an R&D service contract where the customer owns the findings at the end of the day. And the third criteria is the company's performance does not create an asset with an alternative use to the company, and the company has a right to payment for performance completed. This last criteria was designed to help companies assess control in situations where applying the first two criteria are challenged. An example that's relevant to professional service that may fall into this category would be a contract to provide consulting services where the customer receives a written report when the work is completed and is obligated to pay for work completed to date if the contract is canceled. In this situation, the revenue would be recognized over time because no asset with an alternative use is created, and the company has the right to payment based on. So the criteria to be recognized at a point in time, basically, if you don't meet any of the first three criteria I just talked about, then you're going to recognize revenue at a point in time. When you consider this, you need to consider control, and when does the customer obtain control? The guidance lists 5 indications for control that you should be aware of. The customer has present right to payment, they have legal title, physical possession, they have the significant risks and rewards of ownership, and the customer has accepted the asset. As we've said many times already, this is going to require management judgment, and you need to consider these control factors through the eyes of the customer. And the significant rewards and risks of ownership, that used to be the main focus in Legacy GAAP. Now there are several other factors to consider. So another key consideration for fixed fee contracts are contract modifications. So the ultimate accounting treatment for contract modifications is going to depend on the nature of the modification. The classic accounting answer of it depends. So you need to consider several things if you have a contract modification that's been approved by all parties to the agreement. First, does the modification add an additional good or service? If yes, are the additional goods or services distinct? If they are not distinct, then you would account for the change in the contract modification as a cumulative catch-up adjustment. If yes, does the contract price increase by amount that reflects standalone selling prices for the new goods or services? If the answer to that question is yes, then you account for the modification as a separate contract. If the answer is no, then you would account for that modification prospectively. While we're not getting into details on the calculations for actually recognizing the revenue today, these are just things to be aware of, and if it applies to your industry, these are some hints on how you would ultimately treat those modifications. So now we are on to our third polling question.
All right. What do you think is the biggest impact the new standard will have on your company? Your options are timing of when revenue is recognized, disclosures will be significantly expanded, capitalization of incremental costs, or I'm not sure. I'll give everyone a few minutes to think about that. And for those of you that would like a copy of today's slide deck, you can download them now from the folder that says Slide Deck and Handouts to the right of the slide view. We will also be sending the slides via email after the webcast. Everyone, a few more seconds. And let's take a look at the results. Back to you.
All right, so I would agree both A and B definitely are going to have a big impact to companies. It may not change the timing of when you revenue. It'll depend, but there's a potential there will be some impact there. And the I'm not sure, hopefully by the end of this presentation, you'll have a better idea of how this could impact your company.
So now we're going to dive into principal-agent arrangements. And as a quick refresher, principal-agent transactions involve a third party providing goods or services to a customer. Oftentimes we see this with insurance brokers as well as consulting and engineering firms. So when another party is involved in providing goods or services to a customer, the entity should determine whether the nature of its promise is a performance obligation to provide or control the goods or services, in which case this entity is a principal, or if it is to arrange for those goods or services to be provided by the other party, in which case the entity would be considered the agent. Very important to keep in mind that an entity determines whether it's a principal or an agent for each specified good or service promised to the customer. And so why is this distinction between principal and agent so important? It's important as ultimately it impacts the presentation of the revenue on the income statement. So for principals, when the entity satisfies a performance obligation, they recognize revenue in the gross amount of the consideration which it expects to receive. However, for agent, when the entity satisfies a performance obligation, the entity recognizes revenue in the amount of any fee or commission which it expects to receive. And this fee or commission might be the net amount of any consideration that the entity retains after paying the other party the consideration received. Really, this is consistent with legacy GAAP, where entities need to carefully evaluate whether gross or net presentation is appropriate. And while the new standard is similar to legacy GAAP, the key difference is really that the new guidance focuses on this concept of control. So let's take a closer look at the concept of control under 606. It's really not always clear which entity has control, which we just established, so you will need to perform a thorough analysis of each contract in terms of control. You are considered to have control and will be accounting for the transaction as a principal if you have any of the following characteristics. If you are ultimately responsible for delivering the good or providing the service, if you have the inventory risk, which in case for professional service firms, inventory risk can exist if a customer arrangement involving the provision of services, if an entity is obligated to compensate the individual service provider for work performed, regardless of whether the customer accepts that work, or if you are setting the prices of the underlying good or service, you will consider to have control. With 606, this idea of control and transfer of control as a way to determine whether a performance obligation has been satisfied goes beyond the historical concept of transfer of risk and reward. As we just discussed, each good or service, or sometimes a distinct bundle of goods or services, should be evaluated separately. If a contract with a customer includes more than one specified good or service, an entity could be a principal for some of the goods or services and an agent for others. Again, companies will need to carefully consider whether they serve as a principal or agent in each of their revenue streams involving a third party as part of applying Topic 606. Appropriately identifying the specified good or services to be provided to the customer is a critical step in identifying whether the nature of the entity's promise is to act as a principal or an agent. Keep in mind when evaluating each good or service within a contract, you may determine you are both the principal and the agent. So here's an example of when you might have performance obligations as a principal and as an agent. Say you're an HR consulting firm and you have a contract with a specific client where you are going to do two things. One, you perform services such as identifying and interviewing candidates. Number two, you obtain a license on behalf of the customer to access a third party's database, which will allow your client to find information on the potential candidates. In this case, the third-party database bills your entity on behalf of the customer, and you in turn bill the client. In this particular example, you are a principal in the recruiting services, as you are the one performing those services and no other party is involved. But you are considered to be an agent with the database service, as your company does not control access to the database, does not fulfill access service. When thinking of terms and control, the database company is the one setting the price and is ultimately responsible for providing the service. So they are considered to have control. And your HR consulting firm would be an agent, as they are arranging services between the database company and your client. Now we're going to switch gears a little bit and go through contracts where the transaction price is variable. This relates to step 3 of the 5-step process. For companies that do have contracts with variable consideration, meaning there is uncertainty as to what the final consideration exchange will be, there could definitely be some significant changes as a result of applying Topic 606, especially for those that did not historically estimate for variable consideration, or rather waited until cash was received or outcome was known to a high degree of certainty. Legacy GAAP has various requirements and thresholds for recognizing variable consideration. As a result, the accounting treatment has greatly varied depending on which guidance was applied to a transaction. So depending on which guidance entities have been applying, some entities may recognize sooner under the new standard, while other entities may recognize later. Under the revised guidance, the transaction price only includes the estimated amount that is probable will be realized, will not result in significant reversal. The contingency is resolved. The first step is to identify when contracts have transaction prices that are variable. Then, in assessing whether it is probable that a significant reversal of revenue recognized will not occur once the uncertainty related to the variable consideration is subsequently resolved, an entity shall consider both the likelihood and the magnitude of the revenue reversal. Some of the factors that increase the likelihood or the magnitude of a revenue reversal include whether the amount of consideration is highly susceptible to factors outside of the entity's influence. For example, this could be volatility in a market, judgment or actions of third parties, weather conditions, or a high risk of obsolescence of your good or service. You also have to consider if the uncertainty is not expected to be resolved for a long period of time, or if the entity has a practice of either offering a broad range of price concessions or changing the payment terms and conditions of similar contracts in similar circumstances. Also, if the contract has a large number and broad range of possible consideration amounts. And it's really important to note that the entity's experience with similar types of contracts has limited predictive value. When estimating the transaction price, Topic 606 effectively requires companies to first estimate the total amount of variable consideration from a contract. Then, as a second step, a company will evaluate how much of the total estimated variable consideration should ultimately be included in the transaction price. Another thing to keep in mind is that variable consideration should not consider any losses that may result from credit risk. So the customer's inability to pay for goods or services does not impact your transaction price. This would be considered in step 1 of the 5-step process. So if it's probable the seller will collect the consideration to which it's entitled, the transaction price shouldn't reflect any downward adjustments for credit risk. This is consistent with the legacy GAAP, where any credit risk would be accounted for as an impairment of a receivable or other contract asset. So now we can get into an example of a contract that has variable consideration. So we'll take a look at a contract with an asset manager. The contract with the asset manager contains both a 2% quarterly management fee based on the assets under management, as well as a 20% performance fee of the fund's return in excess of market return. Both of these are considered variable consideration. And it's important to note that the entity will be accounting for these as a single performance obligation. This is because it's providing a series of distinct services that are substantially the same and have the same pattern of transfer. In this case, an asset manager generally does not offer either base management services or performance-based services separately. We will consider these one performance obligation when estimating the transaction price. So a few key items to think about at the contract inception. The promised consideration is dependent on the market, which is highly susceptible to factors outside of the entity's influence. In addition, the incentive fee has a large number and broad range of possible consideration amounts. The entity also has experience with similar contracts, and that experience is of little predictive value in determining the future performance of the market, meaning the old market performance is not indicative of the future performance. Therefore, at the contract inception, the entity could not conclude that it is probable that a significant reversal of revenue would not occur if the entity includes its estimate of the management fee or the incentive fee in the transaction price. But again, this is at inception. So you should update the estimated transaction price at each reporting period. So the first quarter, you can record the management fee because the assets under management is known at that point, but you would not yet record the performance fee. You could record the performance fee at a certain point, which it's not probable that a significant reversal would occur, likely further down the road when the contract is nearing termination. But again, this will require significant management judgment.
Or have our next polling question before we jump into other concerns.
All right, our fourth polling question, how long do you expect the implementation process to take for your company? And your options are less than a week, less than a month, 3 to 6 months, or more than 6 months. And once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the certification widget to the right of the slide view. Give everybody a few more moments to make a selection. And let's take a look at the results. Back to you.
Yeah, I am not surprised. I do think the 3 to 6 months or more than 6 months is really how long it is going to take you to go through this full implementation process, which means it's important to get started on it now, since end of 2018 is rapidly approaching, and it will be effective on 1/1/19.
So now we're going to move on to some other considerations that have arisen in conjunction with 606. Firstly, I want to briefly touch upon a new standard that was issued alongside 606, which is ASC 340-40, capitalization of costs incurred to obtain a contract. Legacy GAAP really didn't provide guidance on accounting for costs incurred related to revenue arrangements, particularly those in the professional services. Some companies have historically capitalized certain costs, while other entities have elected to expense direct and incremental costs associated with obtaining a revenue contract, leading to a large variation of practice and treatment of these costs. With 340-40, entities will now have a consistent framework to account for contract costs. The end result is definitely going to be a significant change in practice for some entities due to the new guidance requiring capitalization of most incremental costs incurred to obtain a contract. So what exactly is an incremental cost? Incremental costs are costs that are only incurred as a result of a new contract. These costs are considered to be recoverable either directly through reimbursement or the margin inherent in any contract. Non-incremental costs would be incurred regardless of whether the contract was obtained. So some common examples of incremental costs would be commission, which would not be incurred unless a contract was signed. And this can be applied to both direct sales employees as well as sales managers. And if you have bonuses that are based solely on sales, those would also be considered incremental. Along with bonuses, some other incentive payments and other compensation that are based on quantitative and qualitative metrics, such as profitability or performance evaluations, likely would not meet the criteria for capitalization because they are not incremental of obtaining a contract. What wouldn't be considered incremental? A good example is travel fees. If you're going to visit a potential client, travel costs would be incurred regardless of whether or not you signed a contract with that client as a result. Same applies for legal fees. During the contract negotiation, parties could walk away and those legal fees would have been incurred regardless. However, a legal contingency cost may be an incremental cost of obtaining a contract if a lawyer agrees to receive payment only upon the successful completion. And determining which costs must be capitalized will definitely require a significant judgment and analysis by management. A few other things to note in regards to capitalization of costs. Companies can no longer just make an accounting policy election to expense these incremental costs. But there is a practical expedient where an entity may recognize the incremental costs of obtaining a contract as an expense when incurred if the amortization period of the asset would have been recognized in 1 year or less. However, you cannot default to the practical expedient if the initial contract term is 1 year or less. In some situations, the amortization period may be longer than the initial contract term. An entity really needs to consider the impact of anticipated contract renewals and amendments when determining if the amortization period is 1 year or less. Again, the amortization period will require judgment from management. An entity will also need to be aware of impairment, as you will have to recognize an impairment loss in earnings if the carrying amount of the asset exceeds its recoverable amount. Entities will now have to monitor and evaluate these assets for impairment.
All right, well, we have just gone over a lot of technical content on revenue recognition, and now we're going to get into some more soft topics for implementation. So when in doubt, basically, for implementation, you're going to use your judgment. Management judgment is going to come into play, and you're going to want to use your judgment and document your conclusions and your thought process, making sure everyone is on the same page for your decisions surrounding how revenue is going to be recognized under. Because as you probably picked up on throughout the presentation so far, this topic is not black and white. There's definitely a lot of gray and a lot of areas where managers are going to have to include their judgment in the. So things right off the bat that are going to be impacted and new processes you may need to have in place that you may not already have in place are going to be surrounding contract modification. So management's going to need a process to evaluate and document each contract modification. And if a separate contract is created from a contract modification, there's going to be more considerations as are there additional performance obligations in that new contract that are distinct from the original promises of the original contract. And separate contracts are going to require tracking accounting tracking, separate costs, billings, revenue recognition by contract. So this is going to be something that it may be a change for you from legacy GAAP, is dealing with the contract modification. And the impact is potentially going to impact a lot more than just your financial statements. There's a lot of other things you should be considering as you're going through your implementation process. Your information systems may require adjustment. Standard contracts and sales agreements that you have in place may need to be evaluated in light of the changes. There may be instances where some of those contracts may need to be written, or they may be okay as is, but it's just something to consider. You're going to also need to consider your sales incentives and commissions arrangements, as Kellie mentioned, about capitalization of costs and capitalization of the cost of attaining a contract and commissions. That is going to have a big impact for a lot of companies. Your internal control processes are going to need to be evaluated and updated for the new standard. If you have executive compensation arrangements that are based on revenue or sales targets, those arrangements may need to be reevaluated in light of the new standard. Your debt covenant arrangements may be impacted, so you're going to want to talk to your banks during this process as well. There also could be implications from a tax point of view that you're going to need to consider, and if you need to invest in any additional software or resources to help you through this implementation process is something else. So what should you do first? Well, you should assemble your team. You want to gather your key internal and external stakeholders, and you want to meet regularly and develop an implementation plan. Assign out roles, have a timeline of your critical paths to implementation, and keep your team accountable for deadlines along the way. As we all know, time moves very, very quickly, and this standard is getting closer and closer. today. With your team, you are also going to want to deal with key questions that have come up. What is the impact on your tax planning? What is the impact on your internal controls? Are there software adjustments that need to be made? And what is your process going to be for identifying that you have a contract, identifying the performance obligations within that contract, and what are your processes going to be around allocating that transaction price, measuring variable consideration? And there's many more questions outside of that, which I'm sure you're starting to develop a list as you go through this training. But there's a lot of things to think about, so having a team in place to deal with this is a critical part of the implementation. And then, lastly, you're going to want to consider what type of transition method you're going to want. So you have the option of a full retrospective where you restate your prior year financial statements to include the impact of revenue recognition, basically as if you had adopted it for 2018 as well for comparative purposes. Or the modified retrospective presentation is an option where you would show the impact to your prior year financial statement in your footnotes, but not actually change the financial statement on the face of your. And you also need to start thinking about disclosure requirements. We are not going to go into detail on all the new required disclosures right now, but Moss Adams did have a webcast a couple months back covering various required disclosures that was relevant to all industries. I'd recommend if you didn't catch that when it was first live, it has been archived on mossadams.com. So you can search for it, and I recommend watching it because the disclosure requirements, there is a lot. Which leads me to my last point, which I would recommend you start to look at public filings to get a sense for the disclosure requirements and the impact of professional service firms. Q1 2018 is the first quarter that public companies were required to adopt. So you can pull 10Q filings right now for comparable companies to yours and get a sense of how it impacts.
So now here is our outline for the road to implementation. What we have done is put together a timeline for the remainder of 2018 because by the end of 2018, you should be set to account for revenue under 606. It's effective for most of us for year ends beginning after December 15th, 2018. So January 1st, 2019, your revenue recognition should be accounted for applying 606. So hopefully right now you're working through phase 1, which again is identifying and scoping your major contract types and revenue streams, then figuring out which revenue stream you're going to do a technical analysis. By Q3, which is coming up shortly, you should be walking through the revenue process with management and other key individuals you want involved. You'll be reviewing your current accounting policies and updating for topic 606, honing in on those key differences between legacy GAAP and the new standard. And again, think about your transition method. Whether full or modified makes the most sense for your financial statement. And hopefully leading into Q4, you'll be in phase 3 where you have performed some of your technical analysis, quantified the impact, as well as started to document your policies and procedures as well as key controls. Lastly, phase 4, which is essentially ongoing, as you will continually account for your revenue under 606 and evaluate the impact to your financial statement disclosures.
Well, we have made it almost to the end of our hour, and so now I'd like to introduce Alison Sellers. She's a senior manager in Moss Adams Professional Practice Group. She has been working with companies on implementation and working with audit teams. And so we wanted to get some details from her implementation so far from Alison. So welcome, Alison.
Thanks so much. I just want to say this session, I have not yet seen a presentation developed specifically for professional services. So this really is a unique session. So everybody that's logged in, I'm hoping that you find it beneficial in recognizing the expertise that we have in the room with us today. So I just want to say thank you to both of you guys before.
for any questions.
Thank you. Appreciate that. So the first question, Alison, which phase of the implementation process do you think is going to be the most time intensive?
So for that one, it will, I almost hate to say it depends. I want to strike it from my vocabulary. But it could depend on whether or not there's going to be significant impacts to how entities may have significant changes in accounting policies and procedures, and then if it's going to drive a change in the system. Some companies are looking at this if they're not quite happy with their current accounting system in place anyway. They may want to consider this a good time to transition, as well as looking forward another year to when they're having to adopt a lease standard. So since everybody's going through transition anyway, might as well go to it all at once. For other companies, I think the biggest one, and kind of regardless of what you're doing, will be the financial statement presentation and disclosures. So no matter the impact to the actual revenue recognition process for your company or the impact to the accounting policies and procedures, every entity impacted financial reporting.
Great. So kind of piggybacking off of that, what are the major challenges?
So for a lot of people, I think it is getting comfortable with the reporting and disclosures. When many of the publicly traded companies were going through this process, almost without a doubt, all of the key stakeholders said, had we known how much time it took to develop our new reporting requirements and the disclosures, we would have started that process much earlier, almost at the very beginning. There's many more disclosures, and of course the public companies have more disclosures than companies that are privately held. But however, with privately held companies, we're used to very limited disclosures surrounding revenue recognition. And now it's expanding to having to include many of the judgments and thoughts and consideration involved. And so privately held companies need to start communicating with stakeholders and owners to kind of explain, okay, in prior years we had one paragraph, and now maybe it's a page or a page and a half, depending on some of the complexities in revenue. So getting individuals comfortable with that extent of disclosures, and then on the accounting side, making sure you have that information to include in your disclosure. So that probably, like I said, regardless of the overall impact, that's going to impact everyone. And I would hate for it to surprise people when they go to report their 2019.
Are you seeing a significant change in recognizing revenue as a result of the new standard?
I would say for the most part, not generally. The ones that are more so impacted are entities that may have a significant amount of deferred revenue, and mostly industries that are outside of the professional services or those that are supporting kind of the construction industries in that regard, because most of the time they were already recognizing revenue either over time at a point in time, depending on the good or services they were provided. So I'd say for most individuals on this call, most likely it won't have an impact.
Great. And then just some final thoughts on general best practices, words of wisdom for everyone on the phone that is maybe panicking, haven't started the process or is in the middle of their process.
Yeah, I kind of was thinking about this, and it's almost like any huge, giant thing you need to tackle, and it always makes you unsettled and uncomfortable and I think kind of anxious that this looming kind of process and deadlines out there. But I hope everybody feels the same way I do when I have something like that in front of me. Once I kind of just rip the Band-Aid off and take that first step and have that initial conversation, whether it's talking to others within your company, your professional service providers, that just kind of lifts a little bit of the weight off of your shoulders, spreads kind of the responsibility around, and gets you going in that first step. So for me, I think it's taking that first step is probably the most important. Having a conversation with others to kind of lay out the plan is really a great step. So I'd say that's probably the most important process, is having that first conversation, identifying the resources you have within your company to tackle this process. If you're able to do all this in-house, if you outsource components, hire temp help if there's a lot of contracts you need to go through. So I think it's just starting this process and getting it in place.
Great. Well, thank you for joining us, providing some words of wisdom. I think we've left just a couple minutes for questions. Emily may.
Yep. We have some time for questions. Let's see. If you have a good and a service in a contract, do you automatically have 2 performance obligations?
I would say the answer to that is I should also strike it from my vocabulary, but it depends. It really does depend. You have to look at the good and service, and they may be so interrelated that you don't get a benefit from one without the other, that would be considered one performance obligation. So you just really need to look at each individual contract and the circumstances to make that determination. So there's a potential that would equal 2 performance obligations. If someone could go out and say the service piece of it, they could outsource that and hire someone separately to do that piece versus the good. So it really does depend, which I hate to have that be what we keep coming back to, but it really is the case.
Thank you. What are some of the considerations for determining if full or modified retrospective adoption is appropriate?
Yeah, that's a really good question as we start to think about how this will actually look on our financial statement presentation. We're really anticipating most of our clients will adopt a modified approach, unless, as Alison alluded to earlier, if you have a lot of deferred revenue. If you have a lot of deferred revenue and you'd be able to recognize that earlier when applying 606, you might want to consider how that would impact your financial statements. If you would have recognized it, and it will just be a net adjustment to equity, and you will essentially never see that income on your P&L. A few other things to keep in mind: with full, you will be restating your prior year financial statements, and with modified, you'll be disclosing the impact of the new standard on your prior year.
I'll just chime in. So with this is Alison again. Between the full and modified, you will have, while we usually always want to ensure the financials are comparable year to year, and the period of adoption, if you use a modified approach, your financial statements for the prior year will be under the old revenue recognition standard, and the year of adoption will be under the new standard. So there will be a comparability issue in that first year, so your users of financial statements will need to understand that, and that's what those additional disclosures will help kind of bridge the gap between the 2 different. So that would be one of the considerations.
All right. I think that might be all we have time for questions. If you have any questions for our presenters that we did not get to, we'll be happy to follow up with you after the webcast, or you can reach out to them directly here. I'd like to thank Lisa and Kelly and Alison for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window, also to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next time.